Hello and welcome to the Future of Finance interview. I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Ian Hunt, a consultant to asset managers, a prominent author, and a frequent conference speaker on digital assets. He has recently co-authored a paper with Steve Whyman, the former head of debt capital markets trading at Fidelity International, now an advisor to regulated firms on digital assets. The paper echoes the celebrated warning of Henry Ford about innovation, the inability to think beyond the status quo. Replicating legacy is squandering the promise of tokenization. We are building a faster horse. Argues that blockchain and tokenization give the financial markets the opportunity to do more than make the status quo slightly more efficient. Instead, Ian and Steve argue we have the chance to build a composable financial system that can add not just efficiency, but dramatically lower costs, widen access to investments, deliver better outcomes for investors, and encourage investment and innovation throughout the economy. Ian, thank you very much for taking the time to talk to the members of Future of Finance.
Well, it's good to be here, and it's very good to speak on this subject, which clearly is close to my heart, close to Steve's heart, and important to the UK jurisdiction.
Well, talking of the UK jurisdiction, one of the points you make very forcefully in the paper is that the City of London is putting its future at risk by failing to embrace the transformation of the financial system through blockchain and tokenization. My first question, quite a narrow one really, is how imminent do you perceive that threat to be in terms of progress relative to other jurisdictions? And I'm thinking here particularly of New York, but also, of course, of Frankfurt and Zurich and Singapore and the UAE.
Yeah, well, the US has taken a lead in stablecoin deployment and regulation, and that gives the impression that the US is kind of ahead in the whole blockchain space. In respect to composable investment and the proposition in the paper, then essentially the US is in the same boat as the UK and Europe, and is looking at predominantly, not exclusively, but predominantly looking at tokenization and blockchain as an opportunity to polish the processes within the existing infrastructure, processes within the existing operating models. Outside there's a lot more ambition. So Singapore, MAS in Singapore, the Monetary Authority of Singapore, has already published a commitment to go beyond application of tokenization to existing infrastructures, to existing operating models, and published a commitment to the achievement of a composable ecosystem as the end point of the tokenization initiative. And as a result of that, other jurisdictions have taken notice, including the UK, because the FCA has itself acknowledged in its the recent fund tokenization consultation paper that a potential outcome for tokenization in the UK should be a composable ecosystem. So this is not new, it's just not what incumbents are doing, and it's not what the dominant approach expresses.
Right, so we're neck and neck with New York, as it were, but Singapore is making the running here. It occurs to me in relation to New York in particular that I mean all financial centers are different, but London is very different from New York. It's primarily an international entrepot rather than a deep domestic capital market like New York. My thought is, how would a sweeping domestic reform in favor of a composable system affect London as an international financial center, unlike New York as a primarily domestic center or Singapore as a primarily regional center?
Well, business is magnetized to but jurisdictions and infrastructures which offer the best service, which are more rapid, which are more responsive to innovation, which offer wider product ranges. And that is exactly what the composable ecosystem is designed and structured to deliver. So exactly the same reason that Singapore wants to be a dominant trading hub, physically and in financial services, financial products. And they see a composable ecosystem as a way of achieving that competitive advantage. The same is true for the UK.
Right. So it would attract issuance and trading activity, which would increase the success of London as an international financial centre.
Yes.
Now, you do say in the paper, and we've talked about competition already, that delivering a composable financial ecosystem is important before someone else beats us to it, as your actual phrase. But you also say later in the paper that regulatory arbitrage has become a fact of life. So, in a sense, this jurisdictional competition, while it helps people, it also potentially hurts them. Do you see this race to tokenization of blockchain, to this composable financial system, as a kind of winner takes all or zero sum competition between jurisdictions? Or
No, it's definitely not a zero sum game. I mean, the whole point of composability is that it broadens a product range and it broadens the market. It expands the market. So we're exactly in a normal inflection point where people will see the downside. They'll see that there are potential loss of jobs, or there are potential loss of roles, or there's a contraction. But if the overall market expands, and we would see that the attributes of a composable ecosystem would significantly expand the total market, then it's definitely not a zero sum competition. Whether it's a winner takes all, well, it's certainly the winner has an advantage, as they always do. At the moment, we are not positioning to be that winner. We're positioning to keep up with the standard application of tokenization to existing infrastructure as other jurisdictions, other established jurisdictions are.
which brings me to the heart of the argument of the paper you've written with Steve, and it's that if we replace our existing instruments with tokens and code existing legal and regulatory obligations into smart contracts, that's all we do, we're going to add very little value. We'll just have the faster horse of your subtitle. But you're also pretty clear that's where you feel the current momentum actually is. As you put it, the default option for most established financial institutions is deploy tokenization, where there is a use case to justify it within the existing ecosystem. In other words, you've got this use case mentality, which I agree with you is dominant in the established industry. But the use case mentality is we're going to get efficiency by tokenizing what we do or have already. Now, that mentality is struggling with the idea of a single or common model, this composable financial system that you've described, which in effect encompasses a wholesale systemic transformation of all products. You put it in the paper as if the tech supports loans, it will support options. If it supports equities, it will support collateral management. If it supports bonds, it will support swaps. So in effect, it's a single design. Whereas this use case mentality we have is this incremental approach. We'll do the bit where it makes sense for us financially. We're not aiming here at a systemic transformation. So what do you feel the dominant use case proponents are missing? Is it simply the opportunity cost here is much greater than the investment cost that they're worrying about at the
I
moment?
don't, I don't think they're just worrying about investment cost. I think incumbents are worrying about uh, the idea of genuine systemic change. And there is a coalescence of interest between existing service providers, existing intermediaries, existing players in the market, and the emergent blockchain companies, because existing incumbents want to keep their roles, they want to keep their revenue flows, they want to look at what they can do to improve that with this new technology that's emerging, but they don't want to go too far, and they don't want to have to change dramatically, and they don't want to have any threat to their revenue flows. So they're naturally looking at the terminology. It is everywhere in the blockchain world about use cases. There's a constant search for where can we find a process within our existing operating models, within our existing business model, where we can apply a bit of this technology and we can make a bit more money, or we can reduce some costs, or we can accelerate. So that's the motivation, the primary motivation of incumbents who are involved in this. And you can understand that. It's a low risk, relatively short term return, relatively limited commitment approach. From the blockchain companies, the emerging blockchain providers, technology providers, they all very much want to show value as quickly as possible, to generate some revenue, to become revenue generating as quickly as possible. So they're in the same game, largely, not exclusively, looking for an opportunity to show that they can improve an existing process. So from both sides of the market, there is a focus down on incrementalism. But we know that the composable ecosystem is not just a different version of the same structure, of the same infrastructure. It's a different thing, and we've got plenty of instances from history where the bulk of the market has focused on incrementalism, and the winners have been those who look at systemic change.
You brought up the disintermediation question, and that's an interesting one, and I'd like to come back to that. But let's just stay with this incrementalism for a moment. And one obvious risk of the incrementalist approach is we end up with two systems, and of course the costs of operating two systems. Is there a positive case for operating two systems? In other words, might the second system serve as the springboard for this systemic transformation that you've described?
Well, we're not remotely saying that. In fact, in the paper, we say there are some current initiatives and current directions and current clarification of regulation is essential and really useful. We need people to be used to the idea that you have tokens instead of other markers of ownership. We need to get people comfortable with the idea of blockchain technology. And there's plenty in the press and the market that scares people about that. So getting to the point where we have regulatory clarity and getting to the point where people are comfortable with with some of the underlying ideas here is clearly useful. The problem that we have is that if we and the danger that we're going into by replicating legacy so determinedly is that we will just rebuild what's there. And if we start piling in the attributes of existing assets and products into special purpose tokens, we start to encode law, we start to encode processes, we start to encode regulations, we start to encode settlement operations into a set of what will become very complex and asset class specific tokens, then we're just replicating the complexity of what's there. We're just delivering ourselves another way of doing what we do now. Now, that isn't supportive to the creation of a composable ecosystem with a single operating model and a single infrastructure. That is replicating what we have now.
Mm-hmm. The problem you have just described of replicating the system we have now is the present system doesn't work so well. And you've described pretty well what's wrong with it. It's very complex, it's very fragmented, it's siloed. So every asset class got its different instruments, it's got its different intermediaries, practices, regulations, laws, products, different ways of distributing those products. It's got different trading mechanisms, it's got different operational or back and middle office operations standing behind it. So if we were to try and distill what's wrong with the present system, is it primarily a question of cost? In other words, the system we have is very expensive. If we have a sort of halfway house with tokenization and blockchain, we might make it a bit less expensive. Whereas if we go for the systemic transformation, we actually transform the costs, both the structural costs and the transactional costs. Does this boil down in the end to let's have a cheaper as well as a better system?
Yeah, cost is part of it, because if you create something which is much more simple and has many fewer moving parts, then it becomes cheaper and it becomes easier to mass produce. So clearly cost is part of this. This is, you mentioned Henry Ford. Now, it's clearly the case that if you reduce the part count and reduce the complexity of manufacture, then it's possible to create a much wider market. So I think if you take a big step back and look at the financial industry, look at the financial ecosystem as it is, it's very like the universe. It's just very big, it's very complex, and it keeps on expanding. So if you have an asset class specific infrastructure, operations, regulations, all the things you said, laws, products, distribution, all of the uh, attributes are not always, but generally different between asset classes and separate product types. So when you innovate, you create more complexity because, and it takes a long time. You have to build new infrastructure to create a new asset class, to create a new product type. You have to have new regulation. You have to mature the legal underpinning. You have to have new operating models. Often you have new roles, and it takes a long time. And it's not untypical for a new asset class or new significant product type to take 5 years to come to the point where it's supported by core systems and is reasonably deployable. And in the meantime, you scratch around on spreadsheets. So, that is the problem. So we have this massively complex and expanding ecosystem in which innovation is disincentivized because it's so difficult. And the more complex, as we know, the more complex a structure becomes, the harder it is to change it. So that's on one side. And then if you look on the other side of what we actually deliver out of financial services, it's strikingly simple. Now, every product out of financial services is just a way of transforming between current value and future flows of value. And there may be many of those, there might be contingent or non-contingent, whatever, but they are just a way of transforming between current value and future flows of value. And
Let, let's
so,
let, let's let's talk about that because we've talked up to this point as if everybody knows what composability is. And by the way, it's a very good point you make there about the system isn't just complex and static, it's actually complex and expanding. It's getting more complicated, more fragmented, more static. Anyway, we've talked up to this point whether we all know what composability is. Now, I'm going to try and describe to you what I think you mean by composability, and you can agree or disagree with me. I think you mean we've got these common, you've begun to talk about it there, we've got these common reusable components derived from what's common to every financial instrument, namely the current value, what you own today, and the future value, what you expect to give or receive in the future, what most of us would understand as the net present value of future cash flows. Now, those basic components offer a complete explanation. This is the simplicity you're referring to, a complete explanation of any financial system. That's the transfer of value through time from investors who want to, of course, convert their current value into future value, their savings into an income stream, and the borrowers who want to convert future value, the income stream they expect, into present value so they can make the investment. Now, using those basic components, I think this is what you're saying, we can build a single operating model and a common technology platform that spans all current financial asset classes. That's what we mean by building a single composable financial system. Do you want to agree with me or disagree with that, and perhaps elaborate on how you see that composable system operating in practice?
yes, I mean, the point is that and this is absolutely universal across mathematics, that the structure of a problem should be reflected by the structure of a solution, and the complexity of the problem, the points of complexity are related to the points of complexity in the solution. And so if what you're trying to solve for is delivering the ability to re-engineer between current value and future flows of value in lots of different ways, but that's basically what you're doing, then the tools that you need at hand to build a solution need to reflect that. And blockchain and tokenization give us those tools in very simple form. So current value is reflected by title, which we can represent in a token, in a static token representing ownership of something current, whether that value is cash or whether that value is solid matter or whether that value is financial. And the other tool that we need is which blockchain and tokenization can deliver to us is the ability to represent an entitlement to future flows of value. And that's not static, that's a dynamic thing, which is going to result in a transfer of value, which in a purely digital ecosystem will be in token form as well. So the that dynamic transfer of value from one participant to another, from one owner to another, in blockchain terms, from one wallet to another, is a future delivery of tokens from one wallet to another. And tokens are programmable, tokens can be potent, tokens can be capable of implementing that themselves. So we can get to the point where we have a representation of current value, we have a representation of entitlement to future flows of value, and we can create automation of that in the entity that represents it. So the implementation of the entitlement is the same as the representation of the entitlement. And as you correctly said, we can build existing assets and products out of those because they're all composed ultimately of the same DNA, of the same constituents. And we can build not just the existing asset classes, we can build new asset classes and new product types and solutions out of the same components without needing to add to complexity. So we're solving a lot of the systemic issues in the current financial ecosystem. We're stopping the financial universe from being complex in the first place. We're stopping it expanding when we innovate. We're reducing the cost and the complexity of operation. And now we are allowing ourselves to deliver much more with much less. So that has to be attractive.
Can we dig a little further into something you just talked about? Because it surprised me when I read the paper. Maybe this is a stupid question, but I did find it surprising you favor there's going to be these two types of token. You've got these ownership tokens and these entitlement tokens, the dynamic ones you referred to. Why can't we just have one type of token that combines or reflects ownership and entitlement as needed? Why do we need two types of token?
For the same reason that trust law is moving in the direction of identifying separately the uh, future rights or future entitlements and existing static ownership. And ownership is a different construct in the composable financial model. Then title tokens really give us a way of referencing off ledger assets, because on ledger, if we've got a financial asset, we're going to represent it through future entitlements. So a very obvious split between title tokens and entitlement tokens is that title tokens give us a way of representing uh, off-chain, off-ledger assets like real estate, like fine art, like jewelry, like commodities. And uh, entitlement tokens are the building blocks for financial assets and financial products. And the other really important point is that we're not building any complexity into these tokens. The entitlement tokens are different from title tokens. Title tokens have a reference asset which determines their value, among other things. Entitlement tokens don't have a reference asset, they just point at a token type that is to be transferred in future. And this avoids an explosion of complexity, because it means that each transfer is singular. So it's transferring a single token or set of tokens or cluster of tokens from one participant's wallet to another. And that means that each of these tokens does just one thing, essentially. It makes it a lot easier to value, it makes it a lot easier to risk assess, makes it a lot easier to trace through complex structures. And these are different structurally from title tokens, which are static and simply point at a reference asset.
Okay, that's clear. Let's talk about the programmability, which you've also brought up. If I've understood your paper correctly, you're envisaging a kind of reliance on coding certain key features into smart contracts. For example, distribution restrictions. You want to avoid mis-selling, so you make sure the smart contract makes sure that the wrong asset isn't sold to somebody for whom it's unsuitable. Uh, Also, entitlements, dividend payments, interest payments can be coded into these smart contracts. But a lot of the regulated financial institutions, including end investors, are going to be saying, well, smart contracts are vulnerable. They'll have coding errors, they'll have logical errors, they will be hacked by bad actors. You say in the paper that actually a blockchain-based financial system is more secure than the present centrally computerized one is. Now, I'm sure both those things can be true, but how do you reassure the established regulated financial institutions that smart contracts are not vulnerable to coding and logical errors and hacking?
All coding is vulnerable to errors, and bad actors are always there, but there are and mistakes are always there. However, we have some, both in the blockchain technology and tokenization, there are and distributed ledger, there are some very strong features which make uh, representation in that technology more secure. So a blockchain has immutable history. A blockchain has a complete record of provenance. A distributed ledger distributes data across multiple participants and is much more difficult to hack as a result of that. So there are features of blockchain, including strong cryptography, which are better than where we are at the moment. And the fact it's not perfect, we shouldn't be making the perfect the enemy of improvement. Also, within the composable ecosystem specifically, the tokens are very simple. So, as against the current approach to tokenization, which is to pile in all of the attributes, the regulations, the laws, the operating model, the settlement processes, the roles, etc., into a token that is asset class specific. Entitlement tokens are very simple. They really have only four major attributes. They have uh, who is the issuer of the token, from whose wallet the transfer, the delivery of value is to take place. What are the tokens that are to be delivered, or the cluster that's to be delivered? So what are they? When does that trigger? So what makes that happen? What event makes that happen, or what date triggers that transfer? And the computation of the terms that determine how many of these tokens are delivered. So that's not it, because there will be other attributes, other fields to make the process manageable. But the core of it, that is expressing the meaning and the implementation of the token, is all encapsulated in those four attributes. So that is enormously simpler than having multiple asset class and product type specific tokens with a whole load of attributes in them, trying to reconstitute and replicate the current process. So simplicity is a protection against error, is the answer to your question.
Mhm. You mentioned transfers there, and this is a slightly nerdy question, but I'm going to bring it up because a lot of members of the financial establishment bring it up with me from time to time. And it's that, oh, blockchain doesn't deliver final settlement, which is a legally defined in almost every jurisdiction that matters. It delivers probabilistic settlement. So is your composable system going to deliver final settlement or probabilistic settlement?
Well, look, this is a different situation, and finality can be established at the moment of execution rather than after what we do now, which is a post trade reconciliation cycle. So we're not comparing apples with apples here. Clearly, we need a legal underpinning for the discharge of obligations. And Steve and I, together with a prominent lawyer and a prominent ex regulator, are working on this in our next paper to define the infrastructure and operating model and its required underpinning in law and regulation. So we recognize that this needs to be clarified, but we also, I mean, we need to see that the situation is different, and we are not in the position where execution and settlement are distinct processes that take place at different times.
You think we need new laws and regulations then?
We a major benefit of the composable ecosystem is that there is only one thing going on. There is only one operating model. There is only one way we're representing and constructing assets and products. Therefore, there can be commonality in law and commonality in regulation. We have to define what that is. It won't be unrelated to the current multiple regulations and multiple legal underpinnings of different assets and products, but it will be a lot simpler and it will be singular.
Okay, so law and regulation have to catch up with the technological reality, I think is what you're
Which is
saying.
what's happening now with conventional with our current approach to tokenization. Law and regulation are catching up, so it is no different for composability. The point with composable investment is that when it does catch up, the result will be very simple and singular compared with the current asset class specific and product specific regulation and law that we have to construct today for each separate class.
Yeah. And to go back to our opening question, this is an area in which London has a competitive advantage, I'd have thought, with its common law system. Anyway, one of the benefits you make clear in your paper is that this new composable financial system facilitates the democratization of investment. Am I right to think that by democratization you mean the personalization, the individualization of investments, investment strategies, investment portfolios?
That's one of them. I think democratization is at least three things. One is a composable ecosystem gives us, as you say, individualization. Because of the self-execution of entitlement tokens and the ability to construct products and solutions outside the current product set, we can individualize at scale, and self-execution will mean that there is no added complexity in the operations or the technology required to deliver that individualization. So whereas at the moment, in investment, unless you're at a very high level of value as a client, then you are delivered commodity. You're delivered one size fits all. You're delivered funds if you're an individual investor. You're not delivered something which matches your financial profile with any degree of granularity. So individualization is a major benefit, and individualization at scale and at lower levels of value is a major benefit. And that's part of democratization, but also fractionalization of tokens and the ability to get down to much smaller levels of investment without operational implications, without cost of delivery from an investment perspective. So fractionalization opens up asset classes potentially to new investors who wouldn't have had the value to invest that would have justified a conventional investment manager in allowing them to invest at a low level of cost. So fractionalization is part of the democratization picture, as is decentralization. So we're giving access to peer-to-peer and as well as individual to market. So in order to participate in a composable ecosystem, you don't have to be hooking up to a central institution in order to trade.
Okay, I'm glad you brought up decentralization because you do say in the paper that decentralization will be a structural property of the composable financial system you describe. But you don't elaborate on that in tremendous detail in the paper. So it really means you're just by decentralization you mean peer to peer, do you?
No, peer-to-peer is part of it, but in a composable ecosystem, there is no single controlling entity required to maintain a register of ownership or to validate the rights of holders, because the title and entitlement are already represented directly on the tokens, and those tokens are held in the participants' wallets, and they're enforced by the rules of the composable ecosystem. So decentralization is not a design preference, it's a structural consequence of the architecture. And ownership, entitlement, settlement all resolve at the token level. And that removes the need in that process for central intermediaries. There is no gatekeeping role there. The infrastructure is imposing the operation that is defined in the composable ecosystem.
Okay, I see what you mean now by a structural property. Now, we touched on this question when we were talking about settlement a few minutes ago, but I'd like to go back to regulation and law. A composable model has been endorsed by the Financial Conduct Authority here in the UK, but does do you think we need a whole new regulatory framework for your model to work?
Let's be clear about what endorsement means. I think the FCA has recognised that a composable framework, a composable ecosystem, is a potential endpoint for tokenization in the UK and beyond. It hasn't committed to that, because it has said that it will do further work to flesh out that framework. And what Steve and I are doing next is meant to be a contribution to that. So being specific about what a composable infrastructure looks like, what a composable operating model comprises, and what the underlying regulation and law needs to be to make this workable. A key feature of composable assets and composable products is that they are composed from underlying components, which ultimately are title tokens and entitlement tokens, and they will inherit the attributes, including the regulations, the constraints, and the underlying law of those tokens. So as you build up through tokens, from tokens into assets, into products, and into individual solutions, then there is no need to have regulation at the product level, the asset level, or the solution level. That regulation and that underlying law will be inherited through the tokens. And to be clear, a major aspect of regulation is clearly to protect participants and to ensure that there is appropriate products and assets and solutions are made available to the right parties. So within the composable ecosystem, we would and what we're defining in the next specification document is a suitability regime in which tokens, issuers, and recipients would be categorized or classified to enable a suitability regime to be implemented. And again, those categorizations, those classifications of tokens, of issuers, of recipients would be inherited up into any structures, assets, products, solutions that are built from them.
Is that suitability how are you going to build, is that how you're going to build investor protection into the model? Because investor protection is the thing the regulators are going to worry about most. They don't want to be reading in the newspapers that people have been lost their life savings because they invested in tokenized assets. So it's suitability that you use to build in the investor protection. Is that right?
It's a suitability regime based on a categorization of issuers. So who can issue what kinds of tokens? What attributes does the token have that makes it more or less suitable? So take an example. If we're representing a bond in a composable ecosystem and it's a fixed rate, fixed term bond, and it has specific dates that trigger payments, and those payments are fixed, then that's a pretty simple entitlement token to encode, or each payment is simple to encode. Its trigger is a date. That date's going to happen. There's no risk with that date not happening unless the world ends. The computation of the amount of tokens, which in this case would be cash tokens, to deliver is as simple as it possibly can be because it's a constant. And the token type that's going to be delivered is a cash token, which is easily evaluated as as a fiat currency, as an equivalent fiat currency. So that's a low risk delivery from an entitlement token. An entitlement token could, say, we were constructing a structured product, something like the equivalent of a CDO or a CDO squared or whatever, then an entitlement token would be delivering other entitlement tokens, which makes the structure far harder to encode or harder to understand. We could have a trigger for an entitlement token which was based on a computation of a rate relativity, which is the kind of thing you're going to have representing, for example, a swap. And under those circumstances, it is not definitely the case that trigger is going to take effect. So there is a risk there. There are all of these are attributes of the tokens of the way they're defined. Our view of suitability is that there would be categorizations which would be part of the governance structure of the composable ecosystem, which would be allocated to those types of tokens and allocated to types of issuer, solidities of issuer, scales of issuer, and levels of sophistication of recipients. And we can then implement a suitability regime based on those classifications.
Now, regulation is not the same thing as law. We've touched upon law here and there as we've had this conversation. Is it possible to give an answer to the question, do we need a whole new legal framework to make a composable financial system possible? Is that a yes or no question, or
I don't think we don't need a whole new. We don't need to create something out of left field, but what we need is a lot simpler and is not asset class and product specific. So at the moment, if we have equities, shares are predominantly in legal terms under company law, and derivatives or certainly swaps are under contract law, trusts are under trust law, and there are compositions of law which apply at the product and asset and solution level. What we will be aiming to achieve in or what we need in defining underlying law for a composable ecosystem is a much simpler set of legislation which ensures that title is valid and title is unambiguous for title tokens, and that obligation is again unambiguously defined and enforceable for entitlement tokens. Those are the two key things. And we need that to be absolutely clear, and we need that to be inheritable up into assets, products, and solutions. So again, that's why we're working on a specification for this as an input to what the FCA describes as the fleshing out of a composable ecosystem. And that's why we've got a senior lawyer involved in the next piece of work.
a very specific question for you. If we build this composable, decentralized, democratized system with investor protection built into it through these suitability tests, would that system be much easier to operate if we had widespread adoption of digital identities?
Digital identities would be useful in a composable ecosystem where we were disclosing the identities of the participants, or the participants are disclosing, for example, their interest to trade to a trust circle of other uh, identified parties. But bear in mind that in a composable, what we've described about the operation of tokens and how we build assets, how we trade, how we implement the equivalent of settlement out of self execution, that is the mechanics of an infrastructure which delivers execution, which allows us to make the mechanics of this work. There could be multiple cultures, if you like, of legal framework over the top of this. So you could have exactly the same set of mechanics and set of behaviors in the tokens, but the consequences of things like default could be totally different. So we could have an ecosystem set up with a composable mechanism where the the culture is caveat emptor, where suitability is not really a consideration. It's up to recipients to get comfortable with the issuers whose tokens they're receiving, and if those tokens are defaulted on, then that's too bad, and that's because of inadequate due diligence on the part of the recipients. At the other end of the scale, you could have exactly the same mechanics of the ecosystem, but an ecosystem in which suitability was enforced absolutely rigorously, where the consequences of default were very, very severe for the issuer up to the point of exclusion from the ecosystem. So the fact that there is a composable ecosystem doesn't mean that there has to be the same culture. There isn't a single overarching governance that is appropriate to a composable ecosystem. That's a matter for the judgment of the jurisdiction that is implementing that ecosystem. But on your question on digital identities, yes, if you're going to have an identity, it's useful if it's definitive. It's useful if it's reusable. It's useful if it's shared across the network or the environment in which the ecosystem is operating. My concern with digital identities is slightly different. I think the way that digital identities are being discussed and debated suggests that a digital identity standard is a bit like a Swift standard or a fixed standard. And what we need to do is to agree a set of attributes that are common to all individuals. And what marks them out is the values of those attributes. Whereas individuals are much more diverse than that. I'm concerned that we will be arguing forever about what is the list of attributes that every individual has that we can embody into a standard. I think it's a much more attractive idea that we have a set of that accreditations can be issued potentially in token form, and accreditations can be accumulated in the wallet of an individual, and that would be a much more flexible and standardized but much more usable form of digital identity that would be appropriate for a composable ecosystem.
Well, it's interesting. One of the things you're driving at there is that a digital identity needs to be conceived more broadly. It's not just a question of this is how this person proves they are who they say they are. It's actually a tool for people to express, for example, their risk appetite, their degree of sophistication.
Yes, exactly, and it's there. I mean, there are already uh, in businesses, fintechs, which are looking to incorporate risk appetite, incorporate uh, investment objectives, and so on into what amounts to part of a digital identity. So, digital identity, the identity of an individual, and is the sum of a set of accreditations, behaviors, ambitions, interests, history, etc. It's an extremely wide thing, and we seem to be assuming that digital identity standard is part of a
Mhm.
iterative, previous computing generation where everything has to be processed as a record in the same format. I mean, surely with AI and with big data and so on, we should be moving to a point where we
Mhm.
can we can we can deal with the fact that one person's digital identity has a different set of contents from another.
Yeah, and those accreditations and attributes can be in the wallet, the digital wallet owned and controlled by that person. It can be as rich or as narrow as people want it to be, I suppose. And I guess you will
Exactly.
you'll be able to do more things if you have more stuff in your digital identity section of your wallet. I think that's
Yes, exactly.
it's very
Uh,
clear. Yeah. Okay. Um, One of the things that occurred to me as I was reading your paper is that uh, it is consistent with the single programmable platform first outlined for me anyway in a BIS paper of was it 2023? Probably longer
yeah.
ago than I care to remember, but IMF and others have also um, elaborated on that idea. Am I right to think that your composable financial system is consistent with those high level ideas put forward by the BIS and the IMF?
Yes, absolutely. We all know that the idea there's going to be one sort of global blockchain that everything happens on is a long way away. Interoperability is a big topic in the blockchain world, and rightly so. We have to be able to create scale while accepting that there is going to be no one single uh, technology in the shorter term or even medium term onto which we can implement a very wide scale composable structure. Um, so interoperability is key. We have to be able to operate across multiple networks.
In my final questions to you, I'd like to go back to the essence of the paper really. And what what you're warning against here is simply replicating the system we have already, replicating the legacy. And this, and we touched on this right at the outset, brings up this famous disintermediation question. You note that a UK equity ISA employs 15 intermediaries, all of which represent degrees of cost. You write that intermediaries are not taken out of the equation, but their roles change, and those adding real value will be winners. In other words, it's not about disintermediation, it's about your ability to evolve as an intermediary to be useful in this system. You also say that the opponents are those firms whose business models extract value from embedded inefficiencies in the current system. In other words, these are the people who don't evolve and keep extracting rents from the system. And you do say very boldly here, we have to be prepared to poke the bear. So who do you, I'm going to phrase this question knowing it's the wrong way to phrase it, but who do you see as the winners and losers here, or the evolvers and non-evolvers here? Perhaps a better way of.
Let's look at this. I will answer the question, but let's look at it from a slightly different perspective.
Mhm.
At the moment, the a worrying aspect of the way that we are uh, evolving regulation in tokenization and approaching how we take tokenization forward is that we're engaging all of the existing intermediaries. And the sort of unwritten agenda is that the first question is, well, what's your role and how does your role translate into this new world? And as if there's going to be an equivalent of every intermediary, every current incumbent's role in any new ecosystem. And it's no doubt very reassuring for incumbent firms that that's how this is progressing. Indeed, in the FCA's policy paper recently, the idea for how a composable framework will be developed and fleshed out is that member firms or regulated firms will be asked for their roadmaps. Well, it's very difficult to have a roadmap for something that isn't there. And it's very hard to participate in something when there's nothing to participate in. And it's very hard to motivate people to motivate builders to create an infrastructure when there are no participants. So somebody's got to break this circle. And the obvious approach that we should take is to look at the attributes of the target ecosystem first, and then work out what services would improve its operation, and therefore what service providers would be useful in this context, rather than just looking at existing service provider roles and asking where they fit in. So clearly, that in a very different ecosystem, which is a lot simpler, there are likely to be fewer roles. But this isn't composable investment. The composable ecosystem idea is not a sort of classic blockchain disintermediation argument. We're not gunning for anyone. We're putting up the attributes of an efficient and simple ecosystem and inviting people to consider what services would contribute usefully to it. So, to answer your question, the winners will be the people who contribute usefully to that, to the operation, the reduction of risk, the improvement of efficiency, and the widening of liquidity in that ecosystem. But their roles are very unlikely to be identical to or really close to the roles that they may fulfill at the moment. So that's who the winners will be. The losers will be people who simply carry on trying to replicate legacy.
Your answer reminds me of Oscar Wilde's joke about socialism, where people, his contemporaries, would say to him, socialism has to be practicable in existing conditions. And his answer was, well, it's precisely the existing conditions that I object to, so we need to change them. And so your argument for describing what the ideal system is and how we can make that work is about how to build your composable system, is not about what's practicable today. It's about
And it's why we're producing a specification of the infrastructure and operating model of a composable ecosystem, not because we think we're going to get that right and we're the only ones who know about this. We're doing it because there has to be something there, and it's not going to be, won't be right, but it won't be massively stupid either. So there has to be something which, without asking incumbent firms for how they think this is going to work, because they aren't thinking that. We have to put something up there that people can recognize and work with and shoot down, and that's what we're trying to do.
the challenge that you issue in this paper struck me as being addressed especially, but not exclusively, to asset managers. Now, in a sense, that's not surprising. Both you and Steve have long histories and personal backgrounds in the asset management industry, but it's also a powerful industry. If they decide to shift where they invest, that can change everything. But it's also an industry which has problems right now. They're balancing this very unstable combination of a shift to low-cost passive products and high-cost alternative asset classes. They're overcoming that challenge by just ramping up asset gathering to try and boost that gross revenue figure. But at the same time, their compliance costs are rising. So there is a margin squeeze going on. So they're kind of in a red queen race here. What prevents asset managers from, because this could transform everything for them, it seems to me, what is preventing them from seizing this blockchain tokenization model wholeheartedly with both hands? What's holding them back?
Well, there are two interpretations of that. What is holding them back from getting involved in the current predominant approach to tokenization of replicating legacy? I'll tell a story on it. I was speaking to the COO of a major fund manager recently, who is very naturally innovative, very naturally ambitious, and understands the technology well. And his answer to why that particular business was not going wholeheartedly into fund tokenization was revealing and consistent with what we've been discussing today. He said, "Well, what if I invest in a project which is going to issue a tokenized fund? That tokenized fund is not offering any more to my investors. It's not offering anything massively different. It might be operationally slightly different or different, and it might be more efficient, but it's not offering anything massively new or attractive to the client. But I have to persuade the board that we should take the risk and make the investment in a new technology to deliver the same thing that we're delivering now. So why should I do that? I don't want to make a fool of myself in front of the board. So they're going to ask me, well, what does the client get out of this? And at the moment, with the replication of legacy, then the client doesn't get very much out of it, apart from a promise of some future efficiency and democratization through fractionalization. But it's just not compelling enough. And this really goes back to the fact that current approaches to tokenization really just look at replacing markers of ownership, shares, units, bond indentures, ISDA agreements, title deeds with tokens. And if you just change the way that you own something, you don't change anything in the underlying. You just change the way that you own it, the way you represent it, how the register works, maybe a bit of how you trade it and how you settle it. But the underlying structure stays the same. Those 15 intermediaries in an UK equity ISA stay the same. So you've created the faster horse. You haven't created a real change. So that's why with current tokenization approaches, it's difficult to persuade asset managers unless they're very inclined to innovation and experimentation to do this. Why fund managers are not engaged wholeheartedly in composable finance, despite the fact that composable investment ecosystem would address a lot of their and provide systemic solutions to a lot of the ingrained issues that are causing grief to asset managers now, including rising costs of regulation and increasing issues with moves into less conventional assets that have more complex operating models, more manual processes. All of these things are addressed by the composable ecosystem. So you would expect that investment managers would be very enthusiastic and it would give them the opportunity to deliver other products. But we come back to the same constraint, which is that there is nothing for them to participate in at the moment. So there's not much point in an individual investment manager on their own can't create a composable ecosystem. Now, there has to be some infrastructure provision in order to deliver that. There has to be some agreement on the underlying law and regulation in order to make that feasible. So we get back to the same chicken and egg thing. If there's nothing to participate in, people are not going to participate. And if there are no participants, then it's a hard job to persuade people to build the infrastructure.
If we lift our sights somewhat above where the financial markets are today and ask ourselves a broader macroeconomic question as a way of getting momentum behind true innovation,